Hi, I'm Tom Guerra, Vice President and Director of Ops for CBIA Energy Connections, now in our 25th year. What follows is an update on the state of the region's energy marketplace, the fundamentals driving pricing, and of course, solutions for your business. Starting with a summary of today's market conditions, the good news is that electricity prices are down from 2022, but still up considerably from the COVID-19 depressed markets of 2020 and 2021. Natural gas commodity costs are also down from 2022. Gas basis or pipeline costs in New England have exploded over the past 2 years and are now nearly double the cost of the commodity, putting significant pressure on price. New England's over-reliance on domestic natural gas and internationally imported LNG make our markets more susceptible to weather events. These factors all contribute to the region's electricity costs, some of the highest in the nation. Because the majority of electricity in our region is generated from natural gas as a primary fuel, we need to look at the fundamentals driving gas pricing in New England, focusing on the four main factors: production, demand, supply, and weather. In addition, we also need to start examining another driver unique to our region that is contributing to our high costs: natural gas pipeline costs. Before we get into our first fundamental, production, we need to take a look at the 10-year NYMEX futures pricing for the natural gas commodity. As you can see, the historic low under $2 pricing resulted from the COVID-19 pandemic-driven demand reductions went away as more and more businesses reopen, culminating in 2022's historic high pricing of nearly $10 a decatherm. The market has fallen off to the mid-$2 range, the break-even point for natural gas producers. The first fundamental we'll need to examine is production. Natural gas production for 2023 has rebounded from last year, up nearly 5%, and is creating a surplus. As quantities of gas in storage have grown, gas prices have fallen, causing producers to reduce total rig count by 14% from the start of the year. The second gas fundamental is supply. As you've just heard, today's surplus of natural gas supply has resulted in gas prices below the break-even level. The longer NYMEX prices remain below break-even levels, the more pressure producers will face to curtail less profitable production and further reduce rigs. If we get colder than average temperatures this upcoming winter, our supplies might become inadequate, causing pricing to spike up as it did during our most recent polar vortex. Fundamental 3 is demand. Driven by increased production and reduced LNG exports, U.S. natural gas supply has risen to a record high, exceeding demand. If production curtailment is short-lived, U.S. gas output will hit a record high over the next year, while demand will fall slightly. Our fourth fundamental is weather, and scientists warn that the summer of 2023 could be the hottest summer on record. This prolonged summer heat will put pressure on gas prices in our region, as increased demand for cooling will result in more gas being used for electricity generation. In fact, the impact of both extreme hot and cold weather is most acutely felt in New England because natural gas is the primary fuel that drives electricity pricing, and our region is supply constrained, as you'll hear next. Finally, those of us in New England need to start considering the impact of Fundamental 5, pipeline costs, also called transportation or basis costs. Over the past decade, New England has become increasingly reliant on natural gas for heating, process, and power generation usage, causing tremendous constraints in our limited pipelines, substantially increasing these basis costs. Without any plans for critical infrastructure improvements and/or additional pipelines, New England is forced to import LNG at a rate exponentially higher than domestic natural gas, just to keep our grid stable. According to industry experts, including the heads of major utilities, it is this fundamental that will keep New England's electricity prices substantially elevated for the foreseeable future. Another factor that is driving prices locally is Connecticut's Renewable Portfolio Standards, or RPS. RPS is a state policy that requires both electricity utilities and all retail electric suppliers to supply a specified minimum percentage of customer demand with eligible sources of renewable electricity. Connecticut has some of the highest RPS in the country, and in 2024 mandates that 37% of all power sold in the state be sourced from green energy. This percentage increases annually to 100% renewable energy by 2050. On the surface, RPS seems like a win-win, but recently, a wide range of academic research has shown that RPS produces only a nominal impact on carbon emissions while having a large impact on electricity prices. If all this seems too gloom and doom, rest assured that CBIA Energy Connections is here to help. As you can see, there is continued chance for upside risk, and now more than ever, the market is uncertain and dynamic. For the past 25 years, we've been a PURA-approved aggregator and a trusted resource for thousands of member companies, and we can operate in all the deregulated states. Our solutions include fixed or indexed priced electricity and gas contracts, plus we are able to offer green solutions including solar, battery storage, green RECs, and carbon offsets. The CBIA Energy Connections team will be in touch soon to put a plan together for your renewal. In the meantime, feel free to call us first for all your energy inquiries.